David, can you hear me?
Can you hear me, Michael?
I can hear you now.
And then do I need to undo? I don't have to do undo video or anything, right?
No, because most of your time you're just got the PowerPoint up, don't you?
Yep.
Okay. Yeah, no, you're good.
Yeah. Does that sound okay? Sound clear?
Yes, you do.
Okay. I think my background looks fine.
Well, I wouldn't know. You don't have video on.
Oh, I don't, do I? I'd have to hit start video, wouldn't I?
Yes.
Let's see here. It says failed to start video camera. Please select another video camera setting. I'm not
Weird.
sure. Yeah. I don't know. Well, I guess it doesn't matter. I do have it all set up just in case, but
Okay.
if somebody needed to, or after, you know, I just want to make sure what it looked like after. But I don't. Let's see here. Web camera, that's what I'm using. I don't know why it's not. Let me see here. Let me go down to my camera. Let me go to video. I don't know if that's. I'm not sure why that. Oh, there we are. How's that? Can you see that all right?
Looks good. Yes, I can.
Yeah, I don't think there's anything out in the way, right? And so what they're seeing, part of my my company and stuff, is that something that I should move or does it matter?
No, it's good.
It's good? Okay.
Yeah.
Okay. And yeah, I did put together a little bit more information, so it'll be a little more informative up front about what we talked about, what you want me to make sure that we talk about, which is, of course, you know, how to, you know, even during a pandemic, you know, you can still plan. And so I pulled some materials together, and I know it'll be hard because I won't be on camera, but in the beginning, I'm going to do some things where I'm going to hold it up and say, look, this is where I got the information from, so you know where it's coming from, kind of talk about some actuary stuff, how, you know, the market's kind of where we were, how we got to the recession, how we're coming out of it, but not in depth. I just want them to know that, you know, before all of this, markets had corrections and still can have a big impact on what you're trying to do at retirement, right? So you got to plan. You were planning then, but even in this situation where it's a pandemic, you still need to plan, and you still can plan, because, you know, the types of things that have happened in the marketplace that happened this quickly. So beginning of 2020, we were rocking, and within 3 months, we were in a recession, down 34%. People who are at retirement can't afford that. So that's kind of how I'll do it in the beginning, to kind of walk through it and then explain to them that there are ways to look at this. And one of the things you want to do when it comes to retirement, and not necessarily I'm going to talk about the mutual funds and all that kind of stuff and how you diversify and allocate, that's up to your plan administrator. And if it's Hart, who is a great partner of mine, I'll go through that a little bit. They're going to help you answer those questions, but ultimately we have to plan for income. And so that's how I'll do it. So.
Okay.
So is today the last day?
Yes.
Are you going to stay on a split screen? I kind of like that. Are you going to?
Yeah, but it'll change once you share your screen, though.
Oh, and how do I do that?
Okay. Well, let's make you a co-host first of all. At the bottom of your screen, you see the big green button that says Share Screen.
Yep.
You'll just click on that.
When it's time, or
yeah, when it's time.
Okay, when it's time. So when it gets close to 2:30, just hit Share Screen, and then.
Well, I'll introduce you first,
Perfect.
and then after you say hello, then you can share screen.
Okay, I can do that. Excuse me. I even set up a timer. It kind of lets me know where I am at time-wise.
Okay.
So when we get close to the introduction, because it's an hour and 15 minutes, so hopefully I know I won't have any problem getting through the materials. Just want to make sure I have enough time for questions. So. I do have a fan on in the background. Can you hear that at all?
No, you're good.
Okay. So once I go through my material and I want to start talking about the presentation, I'll just mention it and then you'll throw it up on there.
I'm sorry, I'll do what?
Once I go through the start, I'm going to go through this initial stuff. I won't be in the presentation. I'm just going to be talking, sharing some stuff, and then say, okay, now, to kind of transition into the presentation, then you'll pop it up on the screen for me.
I can, but I just have, is it the same presentation,
Yep.
Missouri?
Yep.
Yeah, I can do that.
Yep. Yeah, because I'll be there where once I start speaking, then I'll share the screen. And then I'll speak for a while and then talk about transitioning into about the importance of figuring out where it is that you stand when it comes to income. And when I start talking about that, I can then say, we're going to go through a short presentation, help you break that down, and then you can pop that on for me. That'd be fantastic.
All right, David, I know it's 2:30, but I'm going to give it another minute just so we can get some more people in. It's the last session of the last day, so
That's fine.
they're dragging their feet.
That's okay. That's okay. That's okay.
I'm pretty sure I told you this before, but I've talked to a lot of speakers over the last 2 months, so I just want to make sure. The session today is recorded and will be available for those who are a part of this conference for up to a year. So some of those that are at another session will come back and watch it recorded. So
Okay.
I don't know how many people will actually have, but it will be viewed by more people.
Sure. Yeah, that's fine. No, I totally understand.
Okay. All right. Well, we'll give them just another minute and then we'll get started.
Okay.
All right. I'll continue to let people in once they show up, but let's go ahead and get the ball rolling. Let me
Want me to share the screen?
just 1 second. So we have had lots of wonderful business partners and sponsors that we want to thank. We couldn't have this conference without them, as well as our wonderful speakers. Today, in our COVID-19 series, we have David Franco, who's going to talk about life post COVID-19, how to, despite a pandemic, still prepare for your future, prepare for retirement, and just know that your finances are on the right track. So I'm going to stop sharing my screen and give it over to you, David.
All right. All right. Thank you. Let's see what we got here. All right. I think I'm on.
Not quite yet.
Okay.
Well, you wanted me to show the deal, so, right? You want me to do the PowerPoint?
Not yet.
Okay.
No. Am I good to go?
Yep, you're good.
All right. Well, good afternoon, everyone. I'm excited to have this opportunity to speak to you today. First of all, like Michael said, my name is David Franco. I have been in the industry for over 30 years. My company, Integrated Financial Services, have been working very close with the housing authorities over the last 10 years. Prior to that, I worked for JP Morgan for many years and assisted a lot of people and a lot of plans over the years. And again, I'm very excited to be here and walk you through this. Yeah, this is a new world for us, right? Not actually being in person, being together in person, but having to do a lot of stuff over Zoom. And the big thing that Mike talked about, which is how during the pandemic are we still able to plan for the future? And it is a little bit of work, but we're going to walk through some things. And first, I'm going to kind of share a little history, kind of what's going on right now with the market, and then jump into how we can kind of keep moving forward so that you are never in a situation where you don't feel prepared for retirement or on that retirement timeline. So, you know, when we talk about what's going on right now with the pandemic and the things that it did, you know, and I've got some information here that, you know, hopefully you'll get a chance to look at. And this is where I'm grabbing my research from, which is the Society of Actuaries. I mean, it's a group that's been around since the 1890s. They're very objective research, the quality, the relevance, and the quantitative stuff that they put together really solidifies what it is that they're trying to share with you when it comes to what we're kind of going through right now. So some of the background as to what's happened and how quickly things can change when it comes to the financial markets. At the start of 2020, and this is just some of the stuff that I'm pulling from the thing here. So when I'm looking down, I'm actually just pulling the actual data from the research reports. 465,000 jobs were added in 2 months. Unemployment was at 3.5%. The S&P 500 was up another 4%, and unemployment was again, it was under control. Within several months past that, right? We're talking February and March. The markets were off 34%. Unemployment was at 14, 15%. I mean, basically the worst since the Great Depression, which of course put us into recession. And that not just us, but the rest of the world. All right. And so that had a big impact. And of course those types of things that happen in a market, when it happens when you are planning for retirement or getting closer to retirement, I'm not saying it's less important if you're a younger person. I'm just saying that time frame is a big thing to look at, the time frame of where you're standing in your retirement timeline. But the impact that it has for those that are getting closer to retirement, and the importance of planning before the 2020 pandemic, okay, is just as important as during. And I think that what you don't want to do is put off thinking, okay, well, there's nothing that I think I can do to make a difference, and you can. One of the groups that I partner with that's fantastic is Heart. I'm sure a lot of you that are out there probably know who Heart is. They've been around a long time, well-established, 475 plus plans, 7,500 participants, and they're a great resource to help give that guidance when it comes to asset allocation and diversification and things like that. All the things that you would do when it comes to sitting down and planning. But the impact of what happened here with the pandemic, if anything, okay, if anything, is even more reason to make sure that you organize and develop a plan. 2, that you implement that plan. 3, you stay diligent. 4, you review it annually, right? And then the 5th thing, which is, I'll kind of go into this just a little bit, it's called never assume. And when I say never assume, it's a thing that I did with my kids. And this is when they were younger and they played sports. And I said to them to just never assume, right? Wherever it is you're supposed to be, be where you're supposed to be, doing what you're supposed to be doing when you're supposed to be doing it. And so I've used that never assume thing, not just in sports, but in life. And I think this is so relevant during this time, right? When we're talking about the pandemic, is to just never assume anything, be prepared, put a plan in place, and reach out to the people that you can trust to help you implement that plan. if that's something that you have a question about, again, as a speaker, I love speaking to any and all. But if you want to reach out and you have a question after all this down the road, no problem. I'll answer the question, but never assume. All right. And as long as you kind of do those types of things, right? Or organize and develop a plan, implement the plan, stay diligent, review it annually. A lot of things can be resolved, right? They definitely can be better. One of the other things I wanted to talk about, which was when it comes to where we are with the market and the frustration that people are going through. And it's tough. And I know because it's your money, it's a tough thing. When you got headlines in the news, there's daily stuff going on, there's market swings, there's stuff going on with the government, there's elections coming up, the Federal Reserve, all of these different things have an impact on what's going on out there. And whether you pay super close attention to it or you don't, the thing is that these things impact what it is that you're trying to do, which is you're at point A and you're trying to get to point B. It's where you are in your retirement timeline to get where you want to be at retirement, right? And so there are a lot of things that you have to do to get there as far as the planning. But once you lay that groundwork, like I said earlier, it becomes much easier, right? Because then you're something that you've got in place and you can make adjustments from time to time, but you can keep moving forward. Excuse me. Here's one of the other things too. When you have folks that are at or getting closer to retirement, there are ramifications of changing conditions that we have are particularly paramount. Yes, we've had market corrections, we've had bear markets, things like that, but when this kind of happens, this is a big deal. Think about this for a minute. Someone that's built up a nest egg, a group of people have built up a nest egg, 30 to 40 years. Let's just say, for example, it's $100,000. Market's off 30%, 34%. That's $34,000. Now, to someone that's younger, right, if they've got 10,000 or 20,000, it's not as big a deal because they've got time to make that up. But the impact of that is it can be catastrophic, right? And so we want to avoid that. And there are ways that we can do that. And I plan on sharing those with you. And I know that some of the questions that you'll have, again, if it's after, I'll be more than glad to answer. If it's down the road here, I'll be more than glad to answer. But today, in my presentation, a short presentation, I'm going to talk about where it is that you are in your retirement timeline, and are you where you need to be? And I've got some actual pieces that you can use that are that with the presentation were attached in the email. I think Michael did that. And if we could get to the slideshow, I want to switch over to that part of the presentation where now that you know what's been going on, how folks are thinking, how it is impacting them. I want to go through a short presentation that shows you how we can plan during a pandemic. Okay, now how we can plan during a pandemic to have a successful retirement income outcome for income. So when we look at the I'm trying to get my slides to slide. One of the things, and probably one of the most important things, and again, I've been doing this for 30 years, and I'm not going to tell you that I have the answer to everything, right? I wish I did, but I've been doing this for 30 years, and I'm very comfortable and I'm very confident in what I'm going to share with you today. It will be very impactful. I have a track record of this. And of course, over the last 10 plus years, directly with the Housing Authority, this information I've shared and how impactful it has been for so many that are participants within those plans. And the big thing when it comes to retirement and I've heard this for years and years and years. A lot of times people will say, well, how do I need to diversify? The allocation diversification. Yes, very important. How much money do you think I need ultimately do I need to have to retirement? You know, am I being aggressive enough, or I'm not being aggressive enough? You know, I'm a conservative person, but I know I need to be more aggressive because, so there's all of this, if, you know, interaction that I've taken to actually put this presentation together. And again, the impact at retirement, really what it boils down is whole financial wellness. How do we get there, right? And one of the things that help us get there and to feel comfortable in retirement is, how confident are you about attaining a comfortable retirement income? That's what it really boils down to. And I know that everyone's situation is a little different, right? For someone who decides they're going to stay at home a little bit more, stay closer to home, not maybe do as much traveling, don't have, you know, the, I would say expensive hobbies, but hobbies that require you to go out and invest your money in. And there's others that want that, right? That want to do the travel, want to do that. So looking at this and figuring this out now before you get there, and then all of a sudden realize, okay, I'm going to be short. What is my next move? And I know that with this short presentation, it's going to open up questions for you. And hopefully the questions also get answered. If they don't, again, I would be more than glad to answer those questions for you, of course, down the road. But how confident, right? The question is, how confident are you in your retirement income? Try to get to this next slide. I apologize. We jumped ahead just a little. Trying to go back up.
David, you want to just tell me when to go to the next slide and all that?
Yeah, that'd be fine. If you can go back up one, that would be great.
Right here?
Nope, all right there. That's perfect. Perfect. I thank you. So, and you know what? Oh, we're back down again. Is that the first? Yep. There you go. So
Okay.
some of the things when it comes to retirement, and the things that are important to recognize is that there are a lot of folks out there that aren't feeling as confident as I would hope they'd want to be, right? You can see here that probably anywhere between almost 50% of the people, whether it's Gen X, late baby boomers, early baby boomers, you know, a little in a spot where they're not as comfortable as they'd like to be. And so what I'm trying to do in this presentation, and I'm excited to share, is that there's a way to attack this so that number, you're not part of that statistic, and how we can keep moving you forward. Because, you know, when we get to retirement, the thing is that we're living longer into retirement. And with that, you have to make sure that what it is that you do have is going to cover that retirement income for you going forward. So you can flip to the next slide. And so when we talk about the longevity part of it when it comes to retirement, you know, back years and years ago, and when I'm talking years ago, when they first came out with Medicare and entitlement programs to assist people as they got close to retirement, people took it at 65. Life expectancy was probably 68, but not today, right? We're living longer and farther into retirement. So the importance of sitting down, identifying, and looking at what it is that you have in your portfolio, the way that it's sitting right now, is it going to be efficient enough to carry you through your whole life? Is it going to carry through your whole life? Because if you do decide to retire at 65, we're now living into our 80s. So that's a long time compared to being 65 and life expectancy was 68. It's a big change. And so living into retirement, the impact of, you know, you not having the type of retirement you want to have, or the income that you want to have at retirement, can make it more difficult. So whole financial wellness is so important. Is so important. Next slide. The average baby boomer out there today has about 88,000. I think that number is probably closer now with some of the numbers have changed. Actually, I think it's closer to 100,000. But sitting down today, we're going to be able to have the ability, right? When you look at this question that here is, do you know how much annual income you'll need at retirement? With the worksheet that you have and the information that you have, I am going to be able to, we're able to be able to walk through that. And again, I know it's hard through a Zoom call, but I'm hoping that what you're getting from this is that there is a plan out there that you can use over and over and over. It's easy to implement, okay? And it allows you to, you know, like I said, get the plan, implement the plan, be diligent about the plan. That all of that, all of those things, and then being able to review it annually can be done from the two sheets that I'm sharing with you today. One's a perspective piece, and the other piece is the actual worksheet to help you identify that and identify where your assets are, how they look, and the type of income you can get from that. But do you know how much income you need to have at retirement? Okay. Something to think about as we go forward. Next slide, please. So for those of you that are logged on, if you had an opportunity to download or print this particular document off, it's the income pie for that talks about all Americans over age 65. It shares where are the sources of income that you're getting for people that are over 65? What are the sources and the percentages? And so in this first perspective piece, and again, when I've had an opportunity to be in front of groups, and there may even be some that are on right now that I may have been to your location or something like that. We've had an opportunity to talk about this, or one of the other previous NARO conferences. But it's such a good piece because everyone's a little different in how they look at where their income's coming from. And so what I'm hoping for you to do is to look at this, look at the sources of income, and just while you're sitting there, just kind of start to try to match up where you think they fit. So if you look at wages and earnings, is it 2.1%? Pension and retirement, you know, is that 39.5%? I want you to kind of just think about that. Because it's, you know, I've done presentations where I've had 15, 20 housing authority employees sitting in a room, and, you know, I could go from one table to the next table and folks have a little different view on where they think income's coming from. Okay. So what I want to share with you is, now that you see that, you can go to the next slide. How did it match up for you? Right? How did it match up? Now, there are some I know that it probably wasn't that hard. It probably got pretty close. But knowing where the income comes from is such an important way for you to plan. Okay? And here's why. If you look at the two biggest pieces of income for people over 65, 39.5% comes from Social Security, and 26.9% of the wages percentage of someone's income comes from wages and earnings. And there are two things that normally I would ask the question, but I'm going to say there are two pieces of this puzzle that you as an individual do not have control over. And, you know, we as you know, human beings, control is a good thing, right? And I don't mean like control somebody. I'm talking, you know, you have control over your life, right? That you choose how you go through life, what kind of job you want, what kind of education, all that type of control. And the ability to have the control over your income at retirement, right? How you retire and where you sit is important. But when you look at two of these particular sources, the two biggest ones, Social Security and wages and earnings, we have no control over. Now think about that for a minute. 39.5% and 26%. So what is that? Maybe 67, 68%. I think that adds up to 60. It's a big number of someone's total income pie is out of your control. So when you retire and how you retire is impacted by that. So yes, Social Security is out there, and yes, it is a automatic, systematic income stream, annuity income. It's an annuity income stream that comes from the government, right? You have no control over it. And it's always in the political realm of what's going on out there. When you look at it either every 2 years or every 4 years, right? Is it going away? Is it going to be propped up? Is it going to be protected? So it's an asset that you don't get to control. So, you know, you work hard, you put money into it automatically, it builds up, and yes, at some point you're going to get an asset. It used to be 65, now it's 67 for full retirement. In the future, it might be 68, 69, 70, right? So it's an asset you don't control. Number two, I get a lot of people who I visit with that say, I do plan on working in retirement, and that's fine, right? You know, I don't know if I can totally retire, I'm gonna work. But there are a lot of folks, right, out there also, when you looked at that figure I said with the baby boomers, early gen, you know, that over half of them believe they're not gonna have enough income. What if when they get to retirement, they can't work? And that's real. And now, right, we want to plan because of what the COVID, right, with the COVID and the pandemic, you know, the industry, right, the employers are making changes and they're shifting how they do business. But if you can't work in retirement, okay, then that 26.9%, right, almost, you know, I'm pushing probably 27%, is an asset that if you can't work goes away. So if you're getting $1,000 a month and now you're not working, now you're down to $750. Okay. And on top of that, you got the fact that you have Social Security, which is an asset that you can't control. So what do we want to, you know, what's important here is what we do going forward. Again, it goes back to the plan, putting a plan in place. So you look at the 19.7%, which is the retirement pension plan, which is what you have when you're talking about the housing authorities. And they've got a wonderful setup. It's fantastic. Taking advantage of that, looking at how you're asset allocated, how you're diversified, looking at your risk tolerances, taking that calculated risk and building on a plan. And yes, Social Security will be there. And yes, you'll probably be able to work. But if you don't, what you know is that there are things out there that you can control. Investment income, if there's, you know, other assets or other dollars that you can put away into other plans, whether it's an IRA, a Roth IRA, different things like that, to build on that, so that 39% and that 26% become a smaller number. And you get to then change that so that, again, you're in control, right? You're in control. And again, you could do these are things that we were doing before the pandemic, and we can definitely do during and after, right? We could be looking at ways to make sure that we do that. Okay. Next slide, please. So when it comes to sitting down and looking at what you're trying to get accomplished, there are 5 key roadblocks. And these are things that I share with everybody. And this is part of what you're going to see when we go through the worksheet, is that these particular 5 bullet points have an impact on what it is that you're doing. But you can meet it head on, okay? The tax burden for that comes from retirement accounts. You know, when it comes to a 401a, 401k, vehicles like that, the assets that you take from the plan, right, are taxable in ordinary income. And so through the years, I've had many, many people come in, they sit down with me, we visit, and they say, hey, you know, I need to have $1,000 a month in income. And I say, well, is that after tax or before tax? And, you know, I run in those situations. They're like, well, I didn't know they were going to tax that. And yes, they do. And so knowing exactly where it is that you are when you have a taxable account and knowing what kind of income you want to have is paramount. Is paramount to having a more successful retirement. Doesn't mean you're not going to have a good retirement. But what I'm trying to do is help you have the best retirement that you possibly can. The best that you can. And so knowing the accounts that you have and how they are taxed is very important. Okay? Investing in a volatile market, again, it's a roadblock. Folks know that they're like, hey, I've got 15 or 20 years till I retire. I'm more of a conservative investor, but I know that you know, I might need to be a little bit more aggressive. But investing in a volatile market makes someone nervous. That's a roadblock. That's a roadblock. And so we have to find ways that we can get around that, right? And so if you're a group out there that's working with Hart and Hart is assisting you, they've got ways to help you understand that and work through it. They really do. They're great at it. How to keep every dollar safe. Again, you know, there's a lot of plans. They've got some conservative investments, and trying to keep your dollars so everly safe in a way is also risk. I'm sure you've heard of this, but I'm going to say these words: buying power. And what buying power is, how much buying power, how much bang for the buck do you get for a dollar? And with inflation, as we go through our retirement timeline, sometimes investing too safe is a tremendous risk to your portfolio. Because if you're not keeping up with inflation, okay, let's say inflation is 3.5%, and you're not growing your portfolio at least at 3.5%, you're not keeping up with inflation, you are losing buying power. Because that gallon of milk is going to be more, that gallon of gas is going to be more, those jeans that you got, that food that you get at the grocery store, it's all going to be more money. So it's important to know that, yes, how do I keep every dollar safe, right? I'm generalizing, right? How I keep that safe. But at the same point, how do I make sure that to not be too safe, right? You got to be willing to take those calculated risks or getting to the goal that you need for retirement. The income that you want to retirement is going to be very, very hard to get accomplished. Okay, changing Social Security benefits. Again, those are things that are going to continue to happen. There's been a lot of stuff in the news lately. Actually, I've got a piece here that said that for the first time, okay, 165 million Americans will witness a Social Security first in 2021. In 2021, Social Security is expected to expand basically the benefits more than what's being collected. That's extraordinary, but it's solvable. Okay, I don't want you to think that, you know, I'm here to say that I think Social Security is going to get taken away or anything like that. I don't believe that. I've been in the industry for 30 years, and for many, many years, I have had every 2 to 4 years, people say, oh, it's getting taken away. Oh, this group's taken away. This group's taken away. This group doesn't know what they're doing. I've heard that all the years, and it's still here. This particular vehicle is solvent through, I think they said 2035, 2034, something like that, 2035. That's a long time yet. So they have ways to do this, but it's the first time in 2021 that more money will be taken out that's been put in. And to me, when I look at that, I look at it logically. That means that we got to put more people back to work, right? We got to get the economy back up and running at a high volume, get people working, get people getting paid for doing a great thing, and being able to then put money into Social Security, put money in their 401k plan or 401a plan and whatever it is, and keep moving forward to have the whole financial wellness when it comes to retirement. So we can get that turned around, but we got to get the economy to keep it moving forward. So yes, changing Social Security benefits is definitely a roadblock, but it's not something that should stop you from planning what you're trying to do when it comes to income going forward. just know it's there and know how it impacts what it is that you're trying to get to as far as income. But know it's there and build accordingly. Medicare and long-term care expenses, those things are going to continue to be out there, and they're going to continue to go up in price. If we can get our hands around costs, if we get more transparency when it comes to Medicare and long-term care, meaning like we find out when you go into particular, like for example, you go to a hospital, they got to be transparent about everything so that you know. And same thing with pharmaceuticals, to have them come down. If you know you're going into a clinic, you go to a hospital and you're saying, hey, look, I can get the same services at ABC clinic versus 123 clinic, I'm going to go to ABC. And at some point, 123 is going to figure it out and try to be right. They're going to try to get themselves where they're at with what it costs, right? The expenses, get them back in line. Competition will help to hopefully level that off instead of it just growing out of control. But it is definitely something that you have to be thinking about, Medicare and long-term care going forward. Okay. And again, this worksheet's going to help us get where I believe, and I have for hundreds, if not thousands of people that over the years that I've worked with, to help them get there. Next slide, please. All right. So the risks people face today when it comes to what they have out there, there are some risks to principal. Yes, there is some risk to the purchasing power, longevity. There's risks associated with which assets and how to utilize them and all that kind of stuff, retirement income. But this worksheet right here is going to help us figure it out where we are or what kind of shortfalls that we have. But a calculated risk when it comes to principal, the risk when it comes to purchasing power, that calculated risk, those are things that we're going to be able to combat when it comes to working through this worksheet. So the next slide, please. So the worksheet that I have today, and I hope you had a chance to print it off, and if not, when you get a chance to watch this.
It's also posted in the chat section if they need it.
Oh, it is? Okay. The worksheet is really simple and straightforward. Again, not that working with other advisors or financial planners or CPAs or whatever it is that they don't have, I've got a one-page piece that walks through this, and yes, they can have, financial planning can have a very detailed, they're very detailed oriented. You're going to look at every asset and drill down into it. That's not what I'm here to solve. What I'm here to solve is how much you have in those accounts, the types of accounts, how they're taxed, and from those accounts and those account values, how close are you to meeting your income goal? And if you surpass it, great. It doesn't mean that you should just say, okay, well, I don't have to do anything else going forward. No, annually you need to, right? Implement the plan, right? Get a plan, implement it, right? Be diligent, review it, and just never assume. Keep moving forward. And in this particular sheet, it does all of that. And yes, I get the whole, you can sit down and have 3 pages of information written down and know the types of assets that you have. But ultimately, what it boils down to is that at the end of the day, how much money do you have in those accounts, the income that can be drawn from those accounts, and are we going to be sufficient, or are we going to have a shortfall? And if we do have a shortfall, what's the answer, right? How do we solve that? How do we fill that gap? How do we make sure that when you get to retirement, we're not having that conversation that I've had with many people through the years, right? And I'm talking when I was with JP Morgan, the whole thing. They come in, they say, hey, I'm going to retire in 6 months, and I need to have $1,500 a month come out of my plan. And then again, I have the pre-tax and the post-tax conversation, and then it's like, oh my gosh, I didn't know you were taking taxes out. And then the next inquiry conversation, drilling down into this a little bit, is I see the value of your account. You're wanting to take this dollar amount out. This account is going to be gone in 5 years, right? And so what I want to do today is I want to avoid all that. I want to get it so that you recognize it, you see it, You see it on the paper. These are your numbers. This is your data. And we go through that whole sheet. And if you identify or see that there's a shortfall, then at that point, you have to develop a plan of how I'm going to attack that, how I'm going to cure that shortfall. And again, whether it's pre-pandemic or post, doesn't matter. These are things you need to be doing. And probably never more paramount that you're doing it now because of the huge swing that we just saw in the market because of the pandemic. And to think going forward that we're not going to continue to potentially have issues or something's going to pop up and can impact the environment or the economy, well, it's just silly to think that it wouldn't, right? Again, never assume. And as long as you don't and you plan, you're going to be okay. You know, matter of fact, you'll probably be really good to great. But if you plan and you do this, you sit down and you look at it annually, you're going to be great because you're going to know right where it is that you stand. And you're going to be able to make the adjustments that you need to make in your portfolio to meet your risk tolerance to get you to your goal, which is whole financial wellness, the income that you need on an annual basis to have the type of retirement and be able to walk around without the stresses of it. And I'm here to tell you that I can help you do that. Okay, I can help you, definitely help you do that. So looking at the worksheet, we're going to just walk through it. And again, hopefully if you have questions, you'll reach out in an email or call me on the phone and I can walk through this in more accuracy. But the first thing that we look at is, you know, annual retirement income. What is your goal? And what is that number? Now, someone who's 20 or 30, they're probably thinking, I really don't know. And I get it, but it doesn't mean that you still can't plan, right? Because early on, you're just getting working, so Social Security is going to look different. Your account values are going to look different, but it doesn't mean that you still shouldn't plan. Plan now so that by the time you get to where you are, when you're getting close to retirement, it becomes a lot easier. For those that are older, I'm over 50 years old. And so, yes, I know there's a lot of folks that are like that are getting closer to retirement. And yes, it's important, but we can solve for it and we can help you. So whether you're younger, 20, 30, you're 40, 50, or you're at retirement, even at retirement's door, we can walk through this worksheet and I can help you. We can help you solve for the income. So if you don't know what your goal is, as you go through the worksheet, that usually, it unfolds. It unfolds as we're going. How many sources of income do you have? Okay, that goes back to the perspective piece with all the people over 65, still working, pension, other, investment income, Social Security, right? All that. So what we're asking here is, if you know how many sources of income that you have, I want you to write that in there, right? So if you don't know what the goal is, fine. Sources of income, 401a, IRA, Social Security, that's 3. If it's the 401a and Social Security, it's just 2, right? I mean, it could be 4, it could be 5, it could be whatever it is. It could be Social Security, it could be 401a, it could be investment income, it could be a rental property, it could be a side job, whatever it is. Those are sources of income. The next thing we want to look at is how taxable are the sources? How taxable are they? And that's important to look at. How taxable are they? And how many are non-taxable, right? So if you look at that, if you look at Social Security and the 401a, both taxable. If you look at a 401a and Social Security and you have a Roth IRA, you have 2 taxable, 1 not taxable, okay? If you have a side business and Social Security and 401a, those are all taxable, so 3. But if it's a Roth or something like that, or an account that has a bunch of municipals in it or something like that, it's a tax-free vehicle, then those are tax-free, right? So by just looking at this, you already have an idea of where your sources of income are coming from. Now, if you're doing this as an individual, no problem. If you want to do this as a joint, you can. So if you just looked at that and said, okay, you know, my significant other, wife, my husband, whatever it is, you can do that also. So if you've got a couple and be like, say, like for my wife and I would say, okay, we've got 2 retirement accounts. We've got an investment account. We've got a property. Okay, all of a sudden now you can add that all up. So you can do it individually or you can do it together, okay? Or you can just split it up to your husband does one sheet, your wife does another sheet. It all goes to the same area, but it's just a way for you to look at it in a little different angle. Okay, the next one, the roadblocks. I talked about those, right? I talked about those: taxes, volatility, SAFE, changes to Social Security, Medicare, and long-term care. All those things are out there. What I'm doing with this, with the 1, 2, 3, 4, 5, is just to ask each individual to identify whether it's 1, 2, none, or all things that you think about when it comes to thinking about your retirement. You know, do you think, oh my gosh, I do. I think a lot about the taxes. When I get to retirement, I do not want to have to pay that much in taxes. So taxes would be a roadblock. It's something that you want to look at, because if you got all of your money going into taxable accounts, then maybe you might want to think of, well, how do I balance that out? And again, that's a conversation that you could have with Hart, or if it's a personal planner or whatever, but there's definitely things that they can talk to you about. And it goes on and on, right? Whether it's the volatility of the market, the changes, SAFE, and all that kind of stuff. You know, circle the things that you know that are important to you, and then have a more in-depth conversation with the people that are important to you to help you in these decision-making, to help move you through that, so that you can do and make the changes you need to your portfolio or portfolios to get you to your end goal, right? Your income end goal at retirement. Okay. The next piece, all right, 70 to 90% is the benchmarks they use there. I've seen it as low as 60%, but 60 to 90% of someone's current income is what you're going to use as a benchmark or a goal. Now, when we look at this, if we have somebody that's 30 years old, they're newer into their career, they're newer into putting money into Social Security, it's still fairly new to them putting in the 401a, the numbers are going to look like, well, once I get done and I know that I need, you know, I know I'm going to need substantially more than this to retire on, my shortfall is going to look ginormous. But really what this is for the younger folks that are looking at this is to establish the plan. Establish the plan, implement it, be diligent, annual review, and just keep never assuming. Okay? So you get in there, you look at your thing, and if you're a younger person, you say, okay, I make $30,000 a year, and you take 70% of that, right? So 7 times 3 is 21. So if you were to retire today, the income within your portfolio that you have today would have to be at least $21,000 for you to be able to just know that your whole financial wellness when it comes to income is there. And again, when you're younger, it's going to be a little different, but it's you need to look at these numbers and start getting used to seeing this. And as you add it into the portfolio, as you continue to get input from someone like Hart, and they're giving you guidance and things like that, how you diversify, how you allocate, you're going to start to see the good ramifications of your good work. Now, someone that's older, 50, maybe 60, it's it's a little different conversation. Because if you're 50 years old and you know that you're going to retire in 15 years, and you sit there and you go, okay, now I'm making a different number when it comes to retirement, and you say, okay, I make $75,000 a year, and you say, okay, well, I make $75,000 a year, and you say, well, I need 70% of that, so you say that's $52,500, and that's what you would write over in that box. So you got 70% of whatever your current income is times 70%. And that comes to $52,500. From there, we take that dollar amount, and as you go down into the first lighter gray box, it says 70 to 90% of current income. You write $52,500. Okay? So now we shift down into the next box. And the next box is the income pie that we talked about. The income pie for people 65 years of age and older. This is you. Okay? That was a average, right? The average person over 65, that's the averages. And 39% is Social Security, 26.7 was people still working. And if you want to totally be away from some of that, these are the things, the numbers that you're putting in here, you're going to see exactly where it is that you sit. And from there, you make the adjustments, right? And again, there's people in place to help you do that. So if wages and earnings is part of that, and you say, hey, yeah, you know what, I'm probably going to work in retirement, and I'm going to do something, maybe something, something where whatever it is, less stressful or whatever, something that maybe it's a hobby, but it's a job, and you want to work. What we do is we take half of what it is that you currently need, which was the $52,500, okay? And we take half of that, and we would just be, let's say it's 25 grand. We could put that in there as off to the side, as that, if I was working, that's what I would probably work for, maybe between $15,000 and $25,000. Because we don't really know for sure exactly at retirement, but if you're thinking about working, it's definitely something that you want to put in there as a figure. Investment income, anything that you have that's a brokerage account, a bank account, CDs, whatever it is, anything that you have that's an investment outside of a retirement plan that generates income, you need to put those values right next to it. So if it says investment income, you say, yeah, I've got, my wife and I, we have CDs. We've got 100,000 in CDs, and they generate, right now, interest rates aren't the best, right? So if right now you had $100,000 and they were generating, and you had 100,000 in there and they're generating 1.5%, that's $1,500. So we would take $1,500 and write it in that, right next to the dollar sign where it says investment income, we put $1,500. Again, you still have that wages and earnings, right? That number there, I'm not putting it in yet, right? I'm not putting it in, but I know that if I get there and I decide to work, then that's something I'm going to put into my plan. So you're going to have kind of option A and option B, if I don't work and if I work, okay? The next piece is Social Security. The average right now is, I think it's probably pushing over 16,000. I've got to make an adjustment to this worksheet, and but it's still very, very relative to the conversation here as far as what we get on an average basis. I strongly, strongly, strongly recommend you go to ssa.gov and you check out where it is exactly you stand today. Having accurate numbers is going to make this worksheet extremely relevant. Extremely relevant. If you don't, then it's just kind of for naught, right? It's kind of like we're putting on a nice suit, but don't shine your shoes. You've done all that hard work, but then you just don't shine the shoes. And I'm telling you, this will work. So if you don't know, then we go with the 15. If you do know, then you write that in there on that line right next to this, the dollar sign, and you scratch out the 15 too. But right now we're going to put the $1,500 in where it is for the investment income, and for Social Security, we're going to keep the 15 too. Okay. The next line is the pension and retirement, which is the 401a. It's the 401a and the money that you're putting into it. And so you're 50 years old, and we'll say that it's in the account, and I'm going off of a benchmark of what the average is about 275K at this point as someone age 50. That's going to generate, if you look at it at 5%. So if in the pension retirement, $275,000, and again, you're going to put your own numbers in. This is just an example of somebody at age 50. Is $275,000 times 5%. Again, that's a benchmark number. I've seen it as low as 4, but if you took 5% of the 275, that is $13,750. Okay. Now the next one is others. So if there's any other type of resource or income that you're getting, other than the investment income or pension, you put that in there. If nothing, then that's just a straight line, right? So now you sit there and you go, okay, I'm going to add it up. I'm going to add up 1375 plus the 15,228 plus the 1,500, and that gets me to 30,478. So now I take the 30,478 and minus 52,500, And in this case, it's showing me, right? It's showing me that it's just a little over $22,000 short. Now, when I'm talking about the Social Security benefit, we know that you're not 62 or you're 65 or you're 67 and looking, right? You're looking at these figures futuristically, but it's still extremely relevant, right? It's still relevant to kind of let you know that yes, this is a figure you're going to have at retirement, right? Let's just say it is more than the 15,000 because this is the average of someone retiring at 65. But if you have an account that's worth 275,000 and Social Security and an investment income, and you still can't get to the 52, in another 10 years, you might be making 60, 65. So that is a signal or a sign that you need to make changes, right? Get a plan, get it in place, be diligent, right? I know I'm repeating myself, but these are important things. And I'm telling you that it's a very simple worksheet, but it's very impactful and it's important. Okay. So yes, you got a shortfall. Now, if somebody says, like we said before, we'll go back up to the wages and earnings. Hey, if I plan on working, right, and God willing, you do, and that's fine. Hey, if I work and I make that 15 to 20,000 or 25,000 a year, okay, I get it. Then you can take that 20,000, move it over to the wages and earnings on the other side, and you add that 20. And if you add that 20 in there, option B, right, is that you got the 20,000 minus the 22,000. Now you're short $2,000. Okay, so you see how that works. These are real numbers. Your Social Security values is a real number. Look it up. Get online. Figure out what that number is. Your investment income. You're looking at your actual accounts and coming up with the values, and then we're taking 5% of whatever that value is. Same thing with the pension and retirement. You know what that account value is. What's 5% of that? And then we do the math. Okay? We do the math. But the biggest thing that we see when we do this is, right, everyone's risk tolerance is different. Some people are more conservative, some people are more aggressive. And that's going to drive the numbers to a certain extent. Right? And the fact that pre-pandemic, we still had bear markets and pullbacks and recessions, but we've also had bull markets. And now we're in the pandemic and we're seeing that the market is resilient. It's fighting back. It's pushing forward, trying to get back to that normalcy. And it's going to keep moving forward. But we could potentially see that where the markets are doing great. And 3 months later, what I said in that one piece through the Society of Actuaries, market was off 34% in 2 months. And we can't afford that when we go to retirement because that's a huge impact. So if you had $100,000 in your account and you were living off of that, and all of a sudden it's worth $34,000 less, and you're still taking the same amount of income off, impossible, almost impossible to come out of that. But if we plan ahead and we look at strategies and we look at things to implement to impact the income that we have or we want to have at retirement, it can be done. Like I said earlier, Social Security is it's a guaranteed systematic, basically income annuity stream. That's what it is. That's what they're giving you. Okay? You're getting it. Okay? Yes, I know we look at a lot of defined benefit pension plans and you see them out there. A lot of them, yeah, they're having their hiccups, right? You see in certain states, they're struggling to try to pull that together. They're expensive to run and they can be difficult. But you are in the perfect position with the group that you have. You've got kind of the best of both worlds here, where money's going into the plan for you, but yet you get control of how the assets are allocated and diversified to get you within your risk tolerance to all then get you to your whole financial wellness. But here's the big caveat thing here. How do we find a way to control an asset or assets and find a way to also have some type of guarantee? Yes, we have Social Security, it's guaranteed, but we can't control it, okay? Working in retirement, we don't have control over that. We don't know if we are going to be able to retire or not. okay? But there are vehicles and things that you can use that you can control the income, you can guarantee the income, and you can tie the return of the income to the markets without being in the markets. And it's a way for you to be, if you're a conservative person, to be less conservative, to still be conservative, but still be rewarded within that source of income, okay? And to generate an income for you over your lifetime, guaranteed. And there's a way to take that asset that you have within there, a portion of what you might have in a retirement plan, and put it into this particular source and to help drive that. So there are ways to get you where you want to be, to get you there, to be able to fill that shortfall, to fill that gap, to have that whole financial wellness, all from this one sheet that we just talked about. And again, if you have questions, I can help you walk through the solutions. But this worksheet is very impactful. Print it off, make 10 copies, make 12 copies. And do one, whether it's, do one, sit down once a year at least, right? We are creatures of habit, and we're also creatures of what we like to do, right? And one of the things we like to do, let's say, for example, like for us, I like to visit family. And I'll plan for, a couple months on when we're going to do it, how we're going to do it, how long we're going to stay, where we're going to go, lining it up with them. But then sometimes when it comes to sitting down and looking at something like this, which is so vital and so important, and I know it's not a vacation. I know it's not a trip. I know it's not buying something, a new car. I know it's not doing certain things that you like. It's not a hobby, but it is so important to do it. And it will take you, once you get through the plan the first time, let's say it takes an hour, right, for us to visit, or whoever you visit with, it takes an hour, a little over an hour. But then after that, every year you're reviewing it at the most 30 minutes, 15 minutes if you have all the information in front of you. But it's so vital. It is paramount that you look at this. So it is a solution before, during, and after a pandemic. This is something you can definitely do. And it's probably never been more important than to do it. And then as you get closer to retirement, if someone's at 60 and going to retire at 65, or at 60 and going to retire at 70, this same sheet can be used. And it will work. And I've done it for many, 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 many housing authority employees, many. And it makes me sleep well at night knowing that, and I love what I do. I'm proud of the work I do. And I want you to have that same security and feeling when it comes to retirement. It definitely allows you to sit back in your chair and let your shoulders just kind of come down and say, hey, I'm going to be all right. I'm going to be all right. So next slide, please. A statistic that's out there, the number is actually a little higher than that. 42% of the people never take the time to sit down and think about their retirement income needs. And I tell you, Michael's, this whole thing about, what we can do or how we can and should we or whatever, when it comes to what's going on right now with the pandemic, never more important. And we're here for you. We can do this. And I think that might be the last slide. I'm not sure. Yes. So I urge you today, right? Don't put it off. Right? You have nothing to lose and potentially everything to gain. And that is so true. And you can go to the last slide. I know, I wish, and I know in the future we'll be able to get together. I know it was a little bouncy. I know that this is a little different. People got to be a little patient, I'm sure, when they watch the video. But we'll get a chance to be able to be in front of each other in person and down the road and as this goes forward. But I can't thank you enough for being on the call. I can't thank you enough for taking the time to watch this and look at it. Information is there if you have any questions. I'll answer them while you're here right now, and I'll do my best to answer them. If not, I'll make sure that I get back to you on that. So thank you. Bye. If there are any questions, go ahead.
Oh, I had a quick question.
Sure.
So would we not be better off paying the taxes now while we're working and can afford them rather than worrying about it later?
Yes, that is the kind of ties into the example of would you rather pay on the seed or the harvest, right? Rather pay the taxes on the seed because it's the small seed that's going into the ground versus paying when it comes to harvest because it's going to be a much bigger number. That is sometimes very hard to do depending on how the plan is set up, right? A 401A plan, unless it has a tax-free version of it. All right, if there's a tax-free version that's tied to the plan, and I know every housing authority is a little different. Some don't, some have it, some don't. So it is impactful, and yes, it does mean a lot. Now, if you're getting closer to retirement, or you're within a shorter window, let's say it's less than 10 years, 5 years from retirement, the impact of doing that now is probably not going to be as much than it would if it was somebody that started it when they were just out of college and starting with the housing authority. Much more impactful for younger folks. Not that you still can't do it, but yes, it is definitely, I would rather pay on the seed than the harvest. And it's good to see you.
It's good to see you.
Yes.
You know, I'll be asking questions.
Oh, I think that's fantastic. I just wish we were all together instead of doing this, but you know, this works.
I know, but we do appreciate you doing this for us.
Yeah. Yeah. Like I said, I know it was a little harder with trying to get through the slides, and I appreciate Michael helping. But you know, if you get a chance to look at the worksheets and use those worksheets, they're so impactful. They're so impactful.
They're depressing.
Yeah. Well, I don't want them to be depressing, but
well, at my age,
we're all getting there.
All right. Any other questions? Well, we want to give a big thank you to David for taking the time to go over this very important information so that we are prepared. We also want to give a special thanks to our sponsors, Create Stone, Texas Municipal League, Grindall, Dynatouch, Yardy, Overland Pacific and Cutler, Revival Development Services, and MRI, as well as all of our business partners that we've had. And David, just thank you so much again for your time.
You bet.
We will have you again soon. We know that you're a good friend of Texas NARO. Thank you so much.
Absolutely. Thank you. Have a great evening.
All right. And those of y'all, this is the last chance for the game. The game code is STORM, S-T-O-R-M. So thank you all so much for a great virtual conference, and we will see how we see you again when it comes to next spring. Be looking for the survey as it comes out so that your voice can be heard. Thank you everyone for your time and for your participation, and we will see you next time.